Good morning and welcome to the Lightcast JOLTS live analysis. JOLTS standing for Job Openings Labor Turnover Survey, a monthly report from the Bureau of Labor Statistics that gives us some indication into the health of our economy. On this March 8th, 2023, I'm your host, Christopher Laney, and I am joined by two extremely talented economists. We have senior labor economist Layla O'Kane and Lightcast chief economist Bloody Teska. Bloody, Layla, welcome.
Thanks, Chris. Happy International Women's Day to us
Excited to
all.
be here. Absolutely. Yes.
Good morning,
Let's
Jason.
get started. Report just came out 30 minutes ago. So, Bloody, I'm going to start with you. What is your first take on what you're seeing, knowing that the job openings did not really drop that much? What do you see? And were you shocked by this?
Well, first of all, good morning again. I don't think we get easily shocked anymore. I think every report in the past couple of months have been kind of shocking in a positive way. I think we're expecting where we're going to slow the economy, where we're going to see the economy slowing down, and we haven't seen it. There's some indication in today's report, but still, the indication is for the economy cooling off, but at a low rate. So we saw openings decreasing compared to December, but they decreased less than, for example, people were forecasting. They decreased to 10.8 million from the forecast was 10.4, I think, around that. And so there are indications of cooling off, but there was nothing significantly shocking in today's report. I think the major thing that we expected to see was sort of like what will happen with layoffs and quits, and there we saw a little bit more action. But I can let Leila talk about that.
Layla, how about you? Specifically to industries, were you shocked by anything among any of the sectors that either lost or added jobs?
Similarly to Bloody, I wasn't shocked by this report. I do think that it's important to remember that the December numbers were revised upwards a little bit. So we did see about a 400,000 decrease in openings overall, which is not that different from the, I think, 500,000 that people were predicting. It just came down from 11.2 instead of 11. So that's why you're seeing it still at around 10.8. In terms of industries, it seems like most of the change is going on in professional services. So there's definitely some stuff going on there where we're seeing that openings were up in professional services and hires were up, but quits were down and layoffs were up. So there's definitely, I think, most action going on there. We're also seeing openings up in construction and in accommodation and food services, down in construction and accommodation and food services. And I think that that's good. I think those are some of the industries that have been struggling to hire. And so having some openings down shows that maybe they're being able to get some talent that they've been needing.
So, Bloody, I wanted to expand on that for just a minute, specifically around construction. Do you think that with, like Layla said, are we just filling the jobs in construction finally? We're getting the talent in those jobs, or is there some other indication in the other parts of our economy on why we would have less job openings in an industry like construction?
Well, we need to triangulate this with the job creation essentially part, and we don't have the numbers today for that. But I'll lean more towards sort of Leila's explanation that actually we are probably finding more people there, and we saw that in January from the employment situation there was like 500,000 jobs being created net, and so that was sort of like the indication that hey, we are actually being able to hire a lot of these people. And actually, this is sort of like we had this a little bit debate. If you look at the hires numbers, the seasonally adjusted versus non-seasonally adjusted, there's a huge jump in hires if you look at the not seasonally adjusted. And the reason I look at the not seasonally adjusted because these are real people. Like it was like 1.4 million people actually net or 1.5 get hired during this period. Again, this includes both people that left their jobs or either because they quit or because they were laid off, and the net job creation that we saw in the January report. So I'll say there's more sort of like, I'll lean more towards the explanation that we're seeing some easiness in some of these industries. But again, this is changing from month to month, so I wouldn't read it too much. And that's sort of like, the openings numbers per self. Like I think it's good to see the overall trend, but the sort of this volatility going month to month, especially by industry, I wouldn't read it too much into it, especially for the job openings. I think the numbers I would look more into is sort of like what is happening with hires, what is happening with layoffs, what is happening with quits, especially in sort of the by industry section.
Yeah. So can we start on quits for just a couple of minutes? Layla, when you look at the quit rate this month, I know there's not a lot in this report that we're shocked by, but when you're looking at the quits rates, is it telling us anything about people, whether they're staying or leaving their jobs, or is it similar to what we've experienced over the last year?
Yeah, I mean, I think as Bloody kind of mentioned in his key takeaways in the beginning, the quits rate did come down somewhat, and it didn't come down substantially, but it came down enough that I think it's noticeable, and that is kind of showing maybe a slowing down of the labor market. So people are less likely to quit their jobs. That means they're uncertain a little bit. They might want to stay, and that means that some of this intense period of openings and churn that we've been seeing might be reducing a little bit. So I think that's a good sign for the Fed that there has been a decrease in the quits rate.
Bloody, you mentioned that it's really important to look by sector at looking at those quits and hires. Specifically, we've kind of touched on the IT tech, kind of that sector specifically. What did the quit rates for this month tell us about the tech sector? Because we still see all the headlines about individuals being laid off. And so do you feel that individuals are becoming more conservative if they're in that industry and they're staying in those jobs?
Well, to be honest, it's a little bit confusing because, and again, I know that's not the answer you're waiting, but because the tech sector is sort of like it's hidden in those two sectors. It's hidden in the is a lot of it is in the information sector, which is small, and you have a lot of the software publishing companies there. But relatively that's a small sector, and then you have this other sector which is called professional services, which there's a lot of tech companies there as well, but also as other type of companies, and so. If you look just at information, right, essentially we did see a small tick down in quits. But the interesting thing, for example, is that openings in information were up. Essentially, there was this reverse from the previous month where we saw a more close to 100% decrease in 50% decrease in openings in information, and now they're going up by 50%. But if you look at the professional services, you get the sort of the opposite picture, right? And in the professional services, you had both quits decreasing and sort of like the hiring part also. I think, the layoffs also increased by 240K in the professional and business services. So you are seeing that in the indication. I would say that effect of the sort of the tech sector, we're not seeing in sort of this information, but we are seeing in this professional and business sector, which does include a lot of the tech companies.
So both of you have alluded to, kind of what the Fed's going to do, what's going to happen. Over the last few days, the Fed has been being questioned right now by Congress about raising interest rates again. And one of the reports I saw was the potential that unemployment could raise to above 4%, or 2 million individuals going on unemployment. When you think about where we're at right now, when you think about the health of our economy, one, do you believe that we are still healthy now, even though we're still having question about the recession and or interest rates going up? And do you believe that the health of our economy, if you do believe it's really strong, do you think it's going to continue through this year? Layla, I'll start with you, and then Bloody, same question to you.
Look, we've been talking about this sort of what is the Fed's ultimate goal? How is that going to play out in the labor market for a year and a half now, maybe? And I think this report should be encouraging, but it's not a end all be all report for the Fed. So I think, we are seeing openings come down a little bit. We are seeing quits come down a little bit. And I think that is a good sign. And, the hope is that we're not going to completely sort of obliterate the labor market in the process of cooling inflation and raising these interest rates. And I think that we're seeing that that's certainly not happening. Whether or not we're cooling down the labor market enough for the Fed to feel sort of comfortable and confident with their position remains to be seen. But I don't think that this report should make them more worried about needing to raise interest rates more quickly than they talked about yesterday.
Bloody, how about you?
I think the Fed right now is trying to make sure that the sort of like that it has a credibility, and that people understand that they are data driven. And although the labor market data has been one of the main indications that they've been watching, I would say that at this moment, really, the inflation numbers are probably the first thing that they are observing. And the numbers that we got for the past month were such that we're actually going in the wrong direction. And so there's a big discussion at this moment, with Jay Powell's speech yesterday. You could see also the stock market kind of quote unquote crashing. So I think that there's a higher, before in December, the expectation was that the next raise in March would be around 0.25%. I think there's more reasons to believe that it might be higher than that. And again, that is sort of like the Fed actually trying to show that they are data driven and that they're going to do, and they're going to act according to what they see in the data. So I do think that today's report sort of kind of, it confronts some of the potential ideas that, the labor market is cooling, but it's not quite there yet. And in essence, I don't expect it to change anything of the decision that they probably would have made. It would be interesting to see the report on Friday as well. Again, that is always complementary to this one, and also is a little bit more up to date because it will be, it will not be for January, it will be for February. But I think these two together, these two reports will inform them about what they're going to do. But today's report showed that we're still in a very tight labor market. I mean, yes, the layoffs are going sort of like in the wrong direction for people, for the economy, maybe in the right direction for the Fed. I'm not sure how to even interpret that anymore, but it's still a tight economy.
Yeah. Leila, Bloody, as we're closing up, Leila, I'll start with you. What are some final takeaways as your analysis of this report?
Yeah, I think the final takeaways here are that openings did come down, but not by as much as I think people were hoping or predicting. We did see quits also come down, so that is sort of a good sign for some slight cooling here in the labor market. And I think most of the change happened really in professional and business services, which, as Bloody mentioned, does include some of those tech sector companies, but we are still not seeing layoffs ricochet into other corners of the economy, and that's good for workers.
Bloody, how about you? Your final takeaways of this report? It's still a very tight labor market. And, we're, again, not sure if we want to be in that situation where say it's not a tight labor market, but, we've been saying that for a long time, and we're probably going to continue to say it for some time now.
Bloody, Leila, thank you so much for your insights. Thank you for joining us for this conversation. You can join us again this Friday for our monthly live analysis of the monthly jobs report. For more information about this analysis or any additional analysis in the labor market, visit lightcast.io. From the Lightcast studios, I'm your host, Christopher Laney, and we will see you on Friday.